So if you've ever thought about participating in alternative investments, things such as startups, hedge funds, venture capital, angel investing, you might want to be familiar with something called being an accredited investor. So today's video should provide some value and some context around this topic. So we're going to talk about what an accredited investor is, why you need to be one, how do you prove it, and if you're not one, what does that mean, and can you still invest? Let's run it. What's going on, everybody? Brian Rivera, CPA, and I wanted to welcome you to the channel. So on this channel, I talk about a lot of different topics: personal finance, entrepreneurship, and investing. So if you're new, don't forget to hit that subscribe button. And if you've been around here for a while, thanks for watching. Recently, one of the things that I've been toying with lately is playing in the venture capital and startup space. So more specifically, I've got an MVP going on an application that I'm currently building that's gonna help traders and investors. And so right now, the project is 100% self-funded, meaning I'm using all my capital to actually get a proof of concept. If there is a proof of concept, from that point forward, I will then potentially explore the idea of raising capital. So in order to raise capital, there's a lot of rules and regulations that not only I need to be familiar with, but also as an investor, I also need to be familiar with. On top of that, a friend and mentor of mine invited me to participate in my first capital raise or venture capital deal to help me get up to speed on the rules and regulations. So it's pretty exciting, but with any startup, there is a ton of risk and you could potentially lose all of your money. But like they say, high risk, high reward. All right, so first up, what is an accredited investor? Accredited investors are typically individuals and or corporations, typically with the means to invest in private and riskier type investments. And so if you're an accredited investor, you are allowed to participate in investments that are not currently regulated by the Security and Exchange Commission. The rule is meant to help prove that sophisticated investors have the intuition and also the liquidity or the capital to weather any storms should something go wrong. I'll remind you that if you look on the Google and you look at the stats, 90% of startup investments fail. And then if you look at a little bit further, between year 1 and year 3, I think that number drops to like 70%. So the likelihood that a startup meets fruition is highly unlikely. But again, typically, if you have an investment that does pan out, you got the next unicorn, you got the next Uber, you got the next Airbnb, Twitter, whatever, it's gonna pay out way more than any losses that you incurred. But the key is that you have to remember that most startups do fail and you could lose all of your money and it turns into a tax loss. So according to the SEC, an individual accredited investor is one who earns $200,000 in the prior 2 years. It's $300,000 if you include your spouse's income, and reasonably expects to make that same level of income in the following year, or has a net worth of at least $1 million, whether that's you by yourself or with your spouse, and that also excludes your primary residence. So most people's most valuable asset in their possession is their primary residence. So according to the SEC, you cannot use this in that calculation. And then within the last 12 months, the SEC also just expanded the rule set on what it means to qualify as an accredited investor. The updated rules allow individuals who are knowledgeable employees of a private fund to also qualify as an accredited investor. Now, this includes financial professionals who also hold the Series 7, 65, and 82 licenses. Now, legal entities that can qualify as an accredited investor include banks, investment broker-dealers, insurance companies, or any entity where all equity owners are considered accredited investors, or trusts with net assets that exceed $5 million. Now, the rules governing the accredited investor are established under SEC Rule 501, Schedule D of the Securities and Exchange Act of 1933, which was established in response to the Great Depression. Absolutely, that was a freaking mouthful, right? So quick funny story, right? When I left my career at a Big Four accounting firm, I actually interviewed at the SEC before I went on to become corporate and then an entrepreneur. I actually interviewed in the Division of Enforcement. So this was an area where they would actually investigate securities fraud, right? So shady transactions. And I remember part of the interview process, they actually asked me about the Exchange Act of 1933 and 1934, which I completely memorized. And I remember the gentleman that asked me the question, and he told me that I was the first person that could regurgitate that thing word for word. Needless to say, they were highly impressed, but I did not end up taking the job. So also known as the Truth in Securities Law, basically what this thing did is it tightened the regulation. Basically, there are more financial disclosures in reporting required of public companies to increase transparency and to reduce basically securities fraud, right? So that is why every single company listed on an exchange has a 10K, right? That's their annual report. They've got a 10Q. They've got earnings releases. Any significant transaction or business combination that a company goes through, that must be disclosed on an 8K. And how that came about is from this rule that was just established. Well, not just established, but this rule that has been around for quite some time. Now, the accredited investor exemption basically seeks to get rid of all this because they're basically saying, hey, if you're an accredited investor, you're able to make a sound decision, you can fend for yourself, and you can weather the storm if something goes wrong. And if something goes wrong, you no longer need the protection of the SEC because you are a big boy and you know what you're doing and you are deploying your capital in investments that you think are commemorative of the actual risk. So some examples of investments that require accredited investors. Case in point, hedge funds. Hedge funds only are allowed to take on accredited investors because they invest in more speculative assets. By taking on more additional risk, they could produce outsized returns. Private equity investments. So typically private equity investments takes on two forms, whether that's venture capital or angel investing, but most of the time these require accredited investors to actually invest. So a quick recap, an accredited investor is basically a fancy way of saying, if you take an L, you can weather the storm and you got enough capital to keep pushing. So let's just say you've got approached with a potential investment and you'd like to participate in it. How do you prove that you're an accredited investor? There's no certification that you're gonna receive that's gonna basically give you a stamp of approval and call you an accredited investor. Typically, companies selling investments typically do the proper due diligence. They'll ask you questions or to certify or opine that you in fact are an accredited investor. So that likely means that you'll have to provide documentation such as your W-2, last 2 years of tax returns, statements showing your assets, your properties, your rental properties, things of that nature to prove that you do meet the test. Now, me being a CPA, obviously for my clients, I do see their financial information. And so a lot of times I will get requests where a client will say, hey, Brian, I'm trying to invest in this real estate project, or I'm working on this type of deal. And they'll send me basically a request to say, hey, can you guys send me a letter so I can prove that I'm an accredited investor? Because we have all their financial information, we're able to provide that. Now, if you're working with your CPA or someone else in your local jurisdiction, you could leverage them to produce this type of documentation so that way you can invest in the project that you are currently looking at. So non-accredited investors, thankfully you have the protection of the SEC, right? You can invest in any public company, real estate investment trust, bonds, as long as it is listed on a stock exchange. You got the New York Stock Exchange, you got the Amex, you got the NASDAQ, you got OTC, you got pink sheets, bulletin board. I mean, there's a ton of different opportunities. So just because you're not considered an accredited investor, you can still participate in other investments, but these ones are governed by the SEC. So how you do that? One is you got to have a brokerage account. So you can sign up for a brokerage account that allows you access to the exchange where you can start investing your money. Or if you want to get even more fancy and you want to go tax-free, you could also use retirement accounts, solo 401ks, all that good stuff. And matter of fact, if you're an accredited investor, you could also leverage self-directed retirement accounts to produce outsized returns on some of these speculative investments. And I got a couple of videos on this stuff, how to get started in the stock market and how someone turned $2,000 into $5 billion in the startup space using a self-directed IRA. All right, guys, moral of the story, I recognize everybody's not at a place where they are an accredited investor. Maybe you don't make enough money yet and you can see yourself getting there in the future, or you haven't acquired enough assets to be there. And that's totally okay. You could still start with traditional investments, real estate, stock market, and as your asset base grows, then you can graduate to more lucrative investments. Now, the reason why you want to be an accredited investor is two things. One is less government intervention, so they're not messing with these because they're not regulated. Two, you get access to more lucrative investments, and I think that is the biggest sticking point. You ever hear those stories about companies when they get listed on an exchange, their valuations come in insane, right? They come in $50 billion, $40 billion. Snapchat's worth more than Delta Airlines, crazy stuff like that. Now, the guys that got in on the ground floor when Snapchat was worth 20 million, and they have been holding for 10 plus years, and by the time Snapchat hits the market, guess what? They're cashing out. They're selling their shares to the guys who like to buy IPOs, right? So if you really want to get in at the ground level, that's when you want to become an accredited investor. I hope you guys found a ton of value in today's video, and if you decide to get involved in this space, just remember there is a ton of risk and you can lose all your money. Because you're an accredited investor, you can weather the storm. Don't forget to smash that like button. Don't forget to smash that subscribe button. And I wish you guys the best of luck on your investing journey. Have a good one.